Hello, everyone, and welcome to today's session Blockchain and Identity Management Building Trust in a Digital World. I'm Shilpa Goswami, and I'll be your host for the day. Before we get started, we would like to go over a few house rules. For our attendees, the session will be in listen only mode and will last for an hour, out of which last 15 minutes will be dedicated to Q&A. If you have any questions during the webinar to organizers or our speaker, use the Q&A window. Also, if you face any audio video challenges, please check your internet connections or you may log out and log in again. If you want to know more, kindly visit our website given in the chat section. Our speaker for today's session, David Palmer. David Palmer is a digital visionary innovator and author. He is the Chief Product Officer and co-founder of PairPoint by Vodafone IoT and Web3 platform Digital Asset Broker. David is also a board member of the Asia Web3 Alliance and the author of the book, The Business of the Metaverse: How Organizations Can Optimize the Opportunities of Web3 and AI. David is recognized as one of the top 20 people to watch in Web3 and one of the top 30 metaverse industry leaders. Most recently, he has been working on the opportunities associated by AI, Web3, IoT, and FinTech to power a new digital operating system and new business models for digital business and enterprises. Without any further delay, I would hand over the session to you, David.
Thank you, Shilpa. A great pleasure to be here with you today to share this talk on blockchain identity management, building trust in the digital world. I'm just going to go from one slide to another. So I think Shilpa's given an overview of who I am. I'd like to say that I've been working in blockchain for many years now. I started out with Ethereum and Bitcoin many years ago. But really, I've been, one of the leaders in bringing blockchains, technology to the telecoms industry, and actively work in that field now. So I wanted to start by really discussing, where we are now and where we're going to be in 2030, just to show, where these technologies are going and how relevant they will be to wider factors, right? So I think the first thing is that the population's increasing. We're expecting that by 2030 we'll have 8.5 billion people, up from 8.1 billion people this year. One of the biggest success stories has been the increase in mobile phones. Of course, coming from a telco background, this is one of the biggest successes we have, with over 90% of the world's population having access to a mobile phone, which has really changed a lot of our business processes, a lot of the way we interact with services, content, and other people. Another one is IoT devices, so that we're expecting that by 2030 we'll have over 30 billion IoT devices, maybe up to 10 devices for each person, but also in business, a lot of connected devices that are shaping our business processes. Another key thing that shocked me was wallets, right? So digital wallets, at the moment there's 4 billion digital wallets, and that we're expecting by 2030 there'll be 5.6 billion digital wallets, which will be the access point for people to interact with and access financial services, and it will be linked to identity as well. So we're expecting that by 2030 the wallet replaces the bank account, and you have 65% penetration of wallets, which is the access to services. In terms of blockchain, we have a question mark on what will happen, because essentially, there's roughly, just over 330 million crypto accounts now. I think a lot of where blockchain will go will depend on how it's adopted, how close it is to AI, how integrated it becomes into mainstream finance. And metaverse is another one where I think the amount of use and the adoption will depend on integration with AI and other technologies. So I think if we look at this, the AI market's forecast to be worth over 1.8 trillion by 2030. 90% of the world's population, will have a mobile phone by 2030. 65% of the world's population will have a wallet by 2030. cryptocurrencies are increasing as we go into some of that later, but the Bitcoin ETF, the Ethereum ETF is definitely showing a lot of institutional adoption of cryptocurrencies. And the current forecast is that the size of the metaverse opportunity could be anywhere between 1 to 5 trillion. Right. So I think the question is, for AI and Web3 to change the world, does it need digital identity? And when we talk about interoperability, digital identity could actually be the interoperability between different technologies, between different platforms. And we start to see it with sign-in by Facebook, sign-in by Google. These are all the beginnings of interoperable digital identity, but they're platform-based. And the question is, if we really want to be able to move quickly between platforms and technologies and ecosystems, is digital identity the key to this? Some of what it will need, are some of the key technologies. So blockchain, AI, linked to digital identity. Even identities for AI, so we can tell which bot is doing what and where the data has come from, will be pretty critical to being able to trust that. Tokens and the ability for NFTs to be digital ownership and be linked to identities of people and organizations, 5G, smart, powerful connectivity, and smart contracts. These are all some of the things which link to digital identity. But will be critical to digital identity really coming to force, as well as the most important one, which is government adoption and policy. So as we're talking about blockchain, it's probably worth looking at blockchain and what's happened so far in 2024. So if we look at some of the positives, and had I given this talk a year ago, all of these arrows would have been red. Right, and it was a different speech, but we're now on an upwards trend, and then we'll just go through some of the key highlights from blockchain trends in 2024. So the cryptocurrency market is roughly around 2.77 trillion, a 62% increase since January. Right, so the market as a whole has gone up 62%. In terms of decentralized finance, 100% increase since December. There's now over 100 billion locked in DeFi protocols. If you look at regulated DeFi and DeFi 2.0, actually there's a lot of overlap now with institutional and traditional finance, which could explain some of the reasons why the foundation is there for growth. In terms of Bitcoin, 100% increase since March last year. So between March 2023 and March 2024, there's been a 180% increase in the price of Bitcoin. And more importantly, in 2024, we've seen the first electronic trading funds approved by the US Securities and Exchange Commissions. Just last week, we had the Ethereum one approved, but Bitcoin one was approved before that. And interestingly, if you look at the 13F filings, so these are institutions who have over 100 million locked in Bitcoin. It's indicating that there's a significant growth and size of institutional holdings in Bitcoin, which is unheard of for such a new for such a new equity. In terms of Ethereum, that's over the period increased 118%. Maybe a bit more if we look at today, but between March 23 and 24, 118%. NFTs, 70 billion market capitalization as of March 2024. The Bitcoin market cap was over 1.4 trillion. The Ethereum market cap, just approaching 500 billion. So, when we speak about blockchain and we speak about the token economy, it's starting to now become pretty significant. And if we look at some of the things around this, there's over 425 million global crypto users, so that's almost doubled in the last 2-3 years. Over 130 countries working on central bank digital currencies, and we're seeing that smartphones are growing. So if we look at this, just trying to give you a size of this Web3 blockchain linked to digital identity market. If we look at the market cap of Bitcoin, which is 1.4 trillion, it would actually make Bitcoin, if you compared it against the sort of top 10 global companies, it would put Bitcoin in fifth, just behind Alphabet and Google. So in terms of size, Bitcoin, if you looked at it, from a global corporation perspective, pretty significant to be in the top 5. And if we looked at cryptocurrency, the global cryptocurrency market capitalization, 2.7 trillion, against some of the GDPs of some of the leading countries, you'd see that the cryptocurrency market would be just under France, but ahead of Russia in terms of GDP. So pretty significant, and I think we're starting to see the beginning of growth. Another way of looking at it is, how does this look in terms of blockchain versus what's happening in banking? And I think one of the biggest changes in the token economy and the cryptocurrency market has been the arrival of institutions and the arrival of banking, right? Not banking in cryptocurrency per se, but central banks looking at central bank digital currencies. But you've also got tokenized deposits. So you see Visa and MasterCard trialing tokenized deposits. Tokenized deposits are essentially where you can move out of a bank deposit into a stable coin or another token, using these products by these financial institutions. We're seeing the HSBC as tokenized gold. We've seen JP Morgan, which is using programmable payments on its with its JPM coin. And we're also seeing these ETFs, right? And this is coming from a very negative position in 2023, where we had the FTX scandal, we had the Terra collapse, 3 hours collapse, BlockFi, Signature Bank, Silicon Valley Bank. And now what we're seeing is a consolidation of financial institutions in the token economy, which are starting to create some products which interoperate and consolidate Web3 into the mainstream finances. So what is digital identity, right? So digital identity can be described as a digital representative of a person, business, IoT device, and their credentials and entitlement, right? And interestingly, if you look at Europe, eIDAS 2.0 is where the EU is mandating policy for a European identity wallet, where it's essentially citizens and business citizens can use trusted, secure digital identity solutions, including digital signatures. The extended digital scope takes this to incorporate archiving, ledgers, and remote e-signatures, right? So this is pretty major, because you have a move to this world of wallets by a major trading bloc like the EU. And if you look at it, there may be two polar extremes of digital identity, in my view, right? So you've got one, which is the Web2 platform digital identity, which is where you don't really have a strong KYC, but you do have an exchange of identity, activity, and credentials for use of platforms, right, in the terms and conditions. And this is pretty typical of social media. On the other hand, you have what we call decentralized digital identity or self-sovereign digital identity. And in this case, it's the polar opposite of the Web2 platforms controlling identity and credentials and access to one where essentially, people and organizations would control their identity and their credentials, and they would give permission for others to verify those credentials. And this is where you have what we call the WC3 standards, and you have the verifiable credentials and decentralized identifiers. And then you've got somewhere in the middle, which is what we call the centralized government regulated digital identity, which is along the lines of eIDAS 2.0. And this is essentially where you have the government or public sector organizations and regulation trying to balance between the platform digital identity model and the self-sovereign digital identity model to find somewhere in the middle. So what does this mean? Essentially, if you look at how this could work, this is something we've obviously done for the EU, but we're looking at essentially having digital identity credentials, which people could link to IoT devices, which could be the credentials stored on chain and cryptographically secured on chain. And essentially, once they're on chain, if I were to put my educational credentials on chain and I wanted an employer to verify that, I would only need for the EU Council or another educational establishment to basically issue that credential, that trusted credential. And then once it's issued and it's secured, then I could allow many employers to see that one issued decentralized identifier or credential. And it starts to bring efficiencies, but it's the model that you're using. And this is an example where essentially that's used for IoT devices and people as well. If we take this further, what is the relationship between digital identity and wallets? Essentially, you're essentially seeing that from a wallet perspective, you could have I think we're moving toward this world of wallets. So 5.6 billion wallets by 2030. But I think if you look at the EIDAS 2.0 legislation, those wallets aren't just for people. Those wallets are for businesses. We are personally, in my role with Peerpoint by Vodafone, looking at identity wallets for IoT devices. And you can have essentially, if you look at all of this digital activity, maybe identity wallets for countries, right? And essentially, as you move towards this world of wallets, which are storing credentials, which are storing tokens and medium of exchange currencies, you're moving towards this world of wallets. How does identity fit in? Because each one of these entities that have wallets will also in them have identity credentials, which can also be verified and sometimes be verified as part of automated transactions between these entities and infrastructure. If you look at self-sovereign identity, again, self-sovereign identity could apply to businesses, IoT devices, humans, but it's pretty important in the sense of having that control, for a person, an IoT device or a business of validated and issued credentials that can be verified automatically, because essentially we then get into the world of being able to have new automated trades and transactions, especially when you look at metaverse and you look at AI, where you're having real-time transactions. Having a digital identity credential, like a payment credential or a age credential, which can be automatically verified, allows for automatic transactions, especially where you have something like an AI agent acting on your behalf. It allows for those credentials to be automatically verified so a transaction can progress. So I think from a business point of view, it's pretty critical. And then essentially you have, if we look at an architecture here, on the one hand, you could have the identity ecosystem, so human ID, IoT IDs, corporate IDs. Essentially, the SIM card and the phone number, could be an intermediary or a bridge between all of these things. So you have one common factor that would allow you to essentially trace back to know your customer and a real entity, that would be, so you could have recourse to legal relations. But essentially, then on the other hand, you have the ecosystem, right? So while you have the identity ecosystem, you have the merchant ecosystem of things like EV charging, citizens, real estate, car registry, education, and essentially where you have the means to automatically, via digital identity, credentials, wallets, cryptography, blockchain, automate, between the two. Then you have these new automated transactions. One thing is, so another question is, what is the relationship between digital identity, wallets, and banking? So as we move towards this world of wallets, and on here, above organization, person, machine wallets, I also put an AI wallet in there because I think that AI bots and AI workers in the new digital realm will start to increase significantly, and they will be transacting on behalf of their owners pretty soon, if they're not already. But also these wallets, as well as holding identity and Web3 payment credentials, can also link to bank, right? So some of the work going on with banks now is so you can have peer-to-peer transactions, within a banking ecosystem or a banking payment network, so that it doesn't need to essentially go outside of that network, and you minimize the transaction costs. So this is also a use case for Web3, but a lot of the sort of big public chains, if you discount layer 2s, are pretty expensive for a peer-to-peer transaction. So you're starting to see the advent in Web3 of layer 2s where you have roll-ups, which make that easier. But this, this will go beyond that to also include, peer-to-peer payments and settlements using traditional banking rails. And when you sum that up, essentially, you have blockchain wallet addresses, smart contracts, cryptocurrencies, and NFTs. A big advancement in wallets and blockchain wallets is the account abstraction, which allows you to move to externally owned accounts, which is an essential linchpin of being able to merge, in my view, platform and banking accounts with Web3 accounts, and that is a key part of interoperability. But then again, all into digital identity. Then you've got you've got personal account numbers, tokens, banking, card, payment rails, which would also be a part of this. And then the key thing, which is missing at the moment, would be the digital identity, know your customer, anti-money laundering, and verifiable credentials, which essentially, then allow for a move to what we call super applications. If you look at Web2 and you look at some of the limitations to commerce on Web2 platforms, a lot of it is because the identity, cannot be verified. Anyone can sign up to a sort of social media account, and a lot of people, the younger people, give the wrong details. Essentially, when you start to have verified, authorized, issued credentials as part of this, well, you don't need to share the data. It could be part of a zero knowledge proof model. But what it allows you to do is to properly verify the credentials on the platform, which are essential for KYC and also essential for these platforms to start having commerce and lending and finance. So if you're looking also at the move to super applications, then the link between digital identity, wallets, banking, and the credentials associated with that, like KYC and AML, pretty critical to letting that go. And then you also have the cross-country and cross-metaverse virtual world settlements. So as we move to virtual worlds, as we move to more digital environments, this becomes a part of GDP. And how you settle, where you have economic from one sovereign nation and their citizens to another in the metaverse and across virtual worlds, will also be the wallet, but the wallet will not essentially be in any one location, but the jurisdiction will. So you have this new form of virtual, digital, or automated trade that will happen. So what have we done? So in my role at Peerpoint by Vodafone, essentially, and you look at adoption, essentially what we're looking to do to kickstart this for IoT devices is to, first of all, link the SIM card to blockchain. So some of the technology behind that is what we call IoT safe. So there's an applet in the SIM which essentially can produce multiple private public key pairs. The secure module in the SIM card can store the private key. More importantly, elliptic curve cryptography in the SIM can build a bridge to certain chains. So Hyperledger, Avalanche, Ethereum, Arch Recorder are some of them. And what does that essentially mean? It means that a SIM card with the IoT safe technology or the proprietary Peerpoint SIM trust technology, which is based on symmetric key encryption, can essentially externally sign on the chain. So essentially, if you look at the big picture where you're saying, okay, let's link to identity, each SIM card is related to the identity of an IoT device, an organization, or a person. That SIM card has the ability, when that dedicated identity is there, to have a digital signature using a cryptographic key, and that digital signature is able to sign on-chain, basically kickstarting and accelerating the adoption and the incorporation of blockchain technology using the SIM as the anchor for the digital identity. We call this the digital identity passport for IoT devices. Of course, with the cryptography, the hardware secure module in the SIM card, and wallet applications, you essentially have the ability to turn any device with the SIM card into a digital wallet that's automatically able to sign, where the blockchain can provide the smart contract technology to automate that. If you look at what this looks like, by 2030, we recently did a study with STL Partners, which forecasts that by 2030, we're expecting 3 billion devices to be transacting in what we call the economy of things. So this is exactly what I said, devices automatically transacting with devices, trusting them, signing and authenticating their credentials, and transacting services, data, or AI. And essentially, if you look at this massive market, but can also link to people. And if you look at some of this in, if we look at this digital identity, verifiable credentials, and zero knowledge proofs in IoT use cases, essentially what we're doing is using digital identity and the WC3 DID methodology to create credentials for certain devices. So in this case, you have the credentials that would be created, or the DID method for a car, and you could see things like who manufactured the car, who owns it, what the VIN number or the identifier for the car would be, any payment credentials, location, and data arrangements that would be part of that. So those are basically encrypted issued credentials for a car, and this could be for any device as well. And essentially on the merchant side, you give them the cryptographic key to unlock and verify those credentials using zero knowledge proofs, right? So you don't even need the data to change hands. So in this case, you could say, okay, does this car have a valid VIN? If the car is crossing a toll, is the location valid, and does it have a payment credential which has the toll fee in? And you can see that this is the basis for friction-free automated transactions using a digital identity and DID schema for a device, with the authentication, for the merchants. And you have this this new form of friction-free transactions. For tolling, we call it tolling without barriers, right? Tolling without hardware. Essentially just using location, identity, and automatic payment to basically create new ways of transacting. The same thing could be done for EV charging. So another real use case that we're working on at Peerpoint, essentially where you're able to assign your identity, if you're a business or a person, to your vehicle. So if you're a person, I could have my car, I could give it a digital identity, I could give the car a payment credential, and essentially if my family wanted to drive it, or I wanted to have a better experience at charge points, then essentially the car could pay on my behalf. If you're a fleet, I think the use case is a bit stronger, because essentially in this case the fleet could give, fleet business could give many cars a digital identity. They could assign a payment credential to many cars, so essentially the car is able to pay on behalf of the fleet and the driver in the fleet. But then they could use digital identity of the person to authenticate many drivers to use where they're authorized to do so, to use the payment credential in the car. So you see this for many fleets, where essentially you move away from a fuel card model, which is assigned to many drivers, where many drivers have a card and they pay on behalf of the car, to one where actually you only need to manage payment credentials for each car, and you can authenticate many drivers to use it, having a simple expense management system and having more control. If we look at smart contracts, really interesting in the sense that smart contracts are essentially the way to automate all of this, right? So when you've got digital identity and you've got cryptography, and you have a use case and an application, especially for IoT devices. How do you automate it, right? And the way that's done in Web3 is through smart contracts, and there's many of them, right? So for digital identity, some of the most popular Ethereum-based smart contracts, and a lot of the blockchains now are EVM compatible, so they run Ethereum virtual machines, which means that they can run Ethereum smart contracts. I'm not saying Ethereum are the best smart contracts, but they've got the biggest ecosystem. So for digital identity, you know, you have ERC 725, and we have the other main one, which is ERC 735. And there's others now that have come to pass, but these are the main ones for digital identity. And then when you link those digital identity smart contracts to things like you know, ERC 0776, which is, you know, use creations and content NFT for collateral for finance. So this is where you can essentially group together many NFTs, you know, and link them to a digital identity, so you can get loans on them. And some of these NFTs are worth, you know, I think the pack was not over 90 million US, right? So you can see how, you know, an NFT represents digital ownership, and you then link it to an identity of someone, and you can then, as I was saying before, link that to a real person or organization, and you can link it to KYC and AML credentials, anti-money laundering credentials. Then you could see how you could automate the translation of those NFTs into collateral for a loan. A wider one, which is where you can create NFTs and make and manage as part of a wider pool, is ERC 4544, which is what we call the creator investment funds. You've got creator assets, so that's ERC 721. And then we've got you know, rental, which is 4907, which is where essentially you could turn a token you know, into what we call a time-bound smart contract, which would essentially allow for someone with an identity which was KYC and AML credentials to essentially, if it was a vehicle, you could rent it. If it's you know, a home, you could rent it, right? So it's opening up you know, identity smart contract, turning that into a collateral, because you've got all the credentials of KYC and AML to breed this new form of asset-based rental, leasing, and even mortgaging, which is massive. And then you've got some others, which is royalty payments, which is 2981. And essentially the 2981 could be part of an investment fund away as well, because this is future payments. So you're seeing how digital identity is absolutely critical to this new digital economy, which is including Web3, which is including tokens, to give rise to new financial models. And that's why there's so much interest from institutions, because this is cheaper, it's very efficient, but it's giving rise to just new ways of doing things, right? Which is immediate and doesn't need so many people and manual processes for authentication. This is all automatic. In terms of some of the risks, so I've been going quite a while now. I mean, if you look at some of the risks in terms of, you know, Web3 and blockchain and digital identity, quantum is a big one, right? So if you look at quantum, and I'm speaking you know, to a cyber team here, so I expect some experts here, but if you look at you know, quantum, some of the threats, so it breaks RSA, which is pretty important. You know, it also breaks the Diffie-Hellman key exchange, and it also breaks elliptic curve. So those top ones there, you know, if you look at it, also a big threat to PKI, public key infrastructure. You know, it's a massive threat to Web3 and blockchains, although you know, there's already a lot of work being done on blockchains to make them quantum proof, right? But that race is, you know, it is increasing, and we're expecting quantum compute to start to be available by 2030. If you look at some of the more quantum secure cryptographies, which are also more expensive, so of course you have symmetric key cryptography, which is you know, more resistant to quantum, but then you have lattice-based, code-based, and multivariate cryptography, which can do that. And you know, if you look at the quantum by 2030, obviously digital identity whilst and Web3, whilst offering a lot of security, visiting fault tolerance being one of them, and the ability to have a lot of security at the edge. There's still a big threat of quantum. One of the things why I like the SIM based approach where that works for SIM based devices is because you have a root of trust at the edge which is based on hardware, which just gives a bit more security and a bit more fight against some of the threats. I'll probably end the presentation there and take questions. So over to you, Shilpa, and we can take it from there.
Thank you very much, David, for delivering such an insightful and informative session. We found the webinar very engaging and hope it was valuable for you as well. Now, before we begin with the Q&A part, I would like to inform all the attendees that EC Council Certified Blockchain Professional Certification covers everything that security professionals need to know to kickstart a career in the blockchain domain. The curriculum addresses fundamentals such as cryptocurrency, assets, and blockchain mining, as well as advanced concepts such as relationship between the Internet of Things and blockchain security, and much more. It also offers hands-on training that teaches learners to solve industry use cases and build decentralized applications. EC Council certification provide course participants with the expertise and practical skills needed for jobs in the blockchain space. According to pay scale, professionals with blockchain technology skills can earn an average annual salary of 112,000 US dollars. If you're interested to know more, kindly take part in the poll that's going to be conducted now. Let us know your preferred mode of training and we will reach out to you soon. David, shall we start with the Q&A?
Absolutely.
Okay. So our first question to you is, how do you think law enforcement, government can best handle the issue of digital identity when it comes to the issue of VPN?
I think that's a good question. Essentially, a VPN is a means of spoofing your location, which exists today. Could Web3 maybe change that? No, but if we knew, who was using different applications, then essentially, law enforcement can, you could use, different methods, once you know who's actually using an application or a platform to actually verify their location. So I think whilst VPNs are good in the immediate term, if we look at where we're actually going, they're not so important, right? One of the things, again, that I've been looking at is things like retail without tills, or retail without barriers. And if you look at that, essentially, you look at the Amazon Go method. Amazon Go was basically saying, okay, the future of retail is somebody goes into a store, they pick up goods and they leave, right? We use a camera to verify who they are. We have a payment credential on hands. They've signed up. We know exactly who they are. So once we verify that they picked up an item and we verify they've left the store with it, then there's an automatic transaction. If you take that further and you said, okay, let's do away with the cameras, but we'll use a mobile phone. Somebody opts in and they can opt in to share their location, and they've already signed up to a payment credential. Actually, we know that that person has, gone into this geofence store, right? This store that's geofence, and we know and we know that they've essentially left that geofence location because with the good, because their location and the goods location are correlated, their identities are merged, and they can leave. Essentially, what you have there is what we call friction-free trusted transactions, where essentially it doesn't matter, whether the detail doesn't matter. What matters is that we know the person, We know they left with the store. We know that we have a payment credential. And once we know that they've left that geofenced location, there's an automatic transaction. I think the same thing is how online transactions will start to evolve. Essentially, we know the person through their digital identity. We know they bought something. Their location becomes less relevant because we're able to verify using a trusted credential the identity of that person in a dynamic way. So I think it will become less and less important the bigger and the more trusted digital identity and verifiable credentials become.
Thank you, David, for answering that question. Our next question to you is, thank you, Mr. Palmer, for the seminar. Could you please explain more about the advantages of SIM-based ID in the quantum era?
Yeah, so a lot of the cellular network is already quantum proof. Well, quantum proof is more quantum resistant. I don't think anything is quantum proof because we haven't had mass quantum proof quantum on there. But whilst cellular-based technology has PKI, which is more vulnerable to quantum, there's two things that are a big advantage. One is the hardware-based side of things, which is authenticated and backed up by the cellular network. And the other one is that in the cellular world, we also use symmetric-based cryptography. So essentially, as we see it in things like in-car payments, for example, you've got two things at hand. You've got what we call an e-commerce-based solution, which is essentially where you're using cryptography and the cloud only with no hardware. And for that, it is slightly more vulnerable than the SIM-based approach, which is essentially where you're able, certainly for IoT devices, to use secure elements, cryptography in the SIM, signing of the SIM, location of the SIM, to basically initiate and validate and sign transactions. So I think the inherent hardware security at scale that we have in the cellular network and the SIM card, is pretty important, even to the point where you can actually store payment credentials and KYC credentials in that SIM card in the hardware secure module. Is pretty important. And then I think the biggest thing is that the scale of it, right? You've got something where essentially you've got billions of SIM cards, including eSIMs out there, which are able to out of the box come with this sort of cryptography, which essentially allows us to have mass availability of quantum resistant technology. So I think it's pretty important when compared to straight e-commerce cloud-based solutions.
Thank you so much, David, for answering that question. Our next question to you is, what are the major challenges that need to be addressed for embarking on a blockchain approach? And with that, does this poise any consumption, energy, etc.?
Yeah, so I think I think a lot of the issues on energy were maybe overplayed. So as you know, a lot of the original blockchains had a consensus protocol called proof of work. So proof of work was very mining and compute heavy, and required a lot of hardware, which essentially you could say had a negative energy. But I think if you look at the move now to new consensus protocols like proof of stake, that isn't the case so much, and there's a lot of studies to show actually that blockchain consensus protocols are now moving to be neutral or even positive. But I think there's another side to it, which is what is blockchain automated trust replacing? And when you look at what it's replacing, is it actually more energy efficient? So if you look at all our processes, right, from going to rent a car, to a passport, to going into a store, to applying for a job, for applying for finance, it's all based on presenting credentials manually, which then need to be verified and the data stored. And if you look at all of those processes, the people going to work, the storing of the files, the processing every day, you'd probably say that it could be as much as 40% of the processes and associated compute we have, because nobody trusts each other. If you then move to a world of digital identity and verifiable credentials, where essentially, you're not having multiple people collecting and verifying and checking multiple credentials. You're actually having those credentials issued once, with multiple entities allowed to verify them using an efficient zero-knowledge proof. You'd actually maybe say the net effect of blockchain and verifiable credentials, would be negative, positive in terms of energy efficiency, because you're saving all of these processes that are happening now and moving to a much more streamlined and energy efficient business process and business models.
Thank you, David, for answering that question. And I will take last two questions for the day. So our next question is, what are the needs for blockchain integration with identity and access management?
Another very good question. So the blockchain needs, I would say the biggest need is to have a blockchain that can, essentially, run smart contracts, and DID methods, decentralized identity methods. I think that's the main thing that you need. Most of the public blockchains, the leading ones, if you look at Ethereum, if you look at Avalanche, if you look at Solana, they all have this capability. So I think that's the main thing for a blockchain to be able to do that. The other one is to have an ecosystem where these identity smart contracts are actually accepted, and this is the big drawback. For as long as I've been looking at blockchain in business, there's been a lot of initiatives and blockchain layer ones that are looking at majoring on identity and self-sovereign identity, and none of them have taken off. And they haven't taken off, in my view, because they haven't had the support of governments and public institutions. Because if you look at the main credentials, banks need to support it, passport office from governments, driver's license authority from governments, electoral roll address from governments. So the main credentials that you need the government to buy in and be an issue on it. And I think that has been the negative side of it. So I think the first thing is that blockchains need to have the security, the scale, and the ecosystems for governments to buy in. If you look at what's happening with the European Union, they're looking at Hyperledger Besu, which is an EVM compatible blockchain, and the major thing is that you're seeing a government now starting to buy into this issue of identities and identity wallets, which is what's missing. For what the blockchains need to do is to make sure that they're acceptable by these governments, because it can't run in isolation.
Thank you, David, for answering that question. Our last question for the day is, what is the adoption rate of blockchain technology in the financial sector in USA compared to Europe, and how sustainable in blockchain technology in developing countries?
Okay, yeah, that's a good question. I did have a slide on this, which is basically showing that blockchain adoption is growing a lot more quickly in developing countries than in developed countries, probably because in developed countries, there's a lot of the population don't have access to financial services or the same level of financial services as they do in the developed world. So blockchain is going to give you the means to open a business or transfer funds or other things. Then the adoption is going to be a lot quicker. Also, another major factor is exchange rate fluctuation, where essentially stable coins are being used to basically hedge assets and income against exchange rate fluctuations, which has been a major barrier to doing business in developed countries. So it's growing a lot more quickly there. If you look at the US, a big driver, as I was saying earlier, has been the Bitcoin and now the Ethereum ETF approval. And if you look at this 13F analysis by the Securities and Exchange Commission, it's showing that there's a significant number of institutions holding over 100 billion, of Bitcoin, and it's almost unheard of for such a new asset class in an ETF. So that's showing that, yes, from an institution and banking point of view, holding of cryptocurrencies, led by BlackRock and some of these other investment funds is starting to increase more quickly. And we've got to remember that the financial world is centered in these areas. US leading the way, I would say now. But you know, when you look further and you say, okay, where is this going to go? There's still some barriers. So there's still regulatory barriers for some banks and financial institutions using a public blockchain and paying gas fees because of sanctions and terrorism checks. So they don't want to pay gas fees, and then the money could be essentially going to a sanctioned organization or individual. And that is something where I think account abstraction could help with there, but that's still a major barrier. But if you look at cryptocurrency, as I say, as an asset class, really taking off now in the US. I think in Europe, we're also starting to get a bit more clarity on the regulatory environment. I'd also say the UK is leading the way on that. So we're starting to see the convergence of Web3 token crypto finance with traditional finances. And I think that is going to take off. But if you look at developing countries, I think that it's still going to outstrip the developed countries, Europe and the US for a while.
Thank you so much, David, and thank you again to our wonderful speaker for answering those questions and for the great presentation and knowledge shared with our global audiences. It was a pleasure to have you with us, and we are looking for more and more sessions with you. Before we conclude the webinar, would you please like to give a small message to our audience?
Yeah, just like I think the message would be, if we look at this journey we're on, in 2013 when I started to get into this, I think most people thought I was absolutely crazy, and they didn't understand cryptocurrency. But I think, and they didn't understand blockchain. But now, we're seeing, big enterprises starting to have, blockchain technology incorporated in their technology solutions and their platforms and their products. So you're moving from proof of concept, and we're starting to see, as I was showing earlier, the asset classes really starting to grow. An equivalent of what we've seen in the Web2 world. A lot of the platforms, that are now household names and huge, didn't exist 15 years ago. So I'd just say in terms of skills, Web3 and blockchain works with AI. I believe it will be absolutely critical to provide dynamic trust and root of trust at the edge for artificial intelligence. But we're also seeing now that it can start to augment and provide important features for traditional finance. And I believe that as we start moving into the virtual world more and more, and we have an increase in the metaverse, that this technology will be critical. So, when you look at where we are with digital identity and blockchain, this will be at the heart of a lot of the trends we have. And for that, I say, thank you for attending this this lecture. It's a good place to position your skills going forwards. Thank you.
Thank you so much, David, for the message to our audience.